Hello, everybody. Welcome back to 21st Century Renaissance and back to another open interest newsletter breakdown on GameStop. I'm your host, Dr. Michael LoPiano. It's wonderful to see you all once again. Happy Tuesday. I hope you all enjoyed the long weekend. Perhaps got to celebrate some time off with family, friends in honor of Martin Luther King Jr. Day and in honor of the presidential inauguration. So wonderful to see that, right? So hopping into today's topic, right? We're coming off of, a very interesting Friday, certainly a very interesting week. We'll take some time to kind of frame what I'm looking at going into this week as a whole, as well as look into some of the specific factors that I anticipate being important turning points with respect to our price action heading into today and the rest of this short week. So for those of you who might be new to these videos, who are joining us for the first time, every day pre-market, I post analytical breakdowns through technical and options analysis approach on GameStop. I post these to my X page. If you're watching this on YouTube, you can find that link down in the description of this video. If you're watching this on X, you can, of course, find this pinned to the top of the page. Today's breakdown is going to focus on a number of factors, but thinking about trying to decipher how traders, institutions may be positioning themselves with respect not only to our recent price action, that is the price action we saw last week, but maybe heading into some potential volatility, which in GameStop would mean downside volatility, which isn't often reflected in the implied volatility, heading into the Bank of Japan decision. So we will hear, of course, this week, that's kind of the big market event heading into Friday. The Bank of Japan is going to meet on Friday, much as they met back last August and are expected, or there is a strong potential that they may decide to raise their interest rates once again. Now, when that occurred last August, there was a mad rush between the period of August 2nd and August 5th to cash out of U.S. equities in order for institutions who had been borrowing Japanese yen to convert it into U.S. dollars and then use those dollars to invest in U.S. equities, suddenly had to deleverage themselves a bit by taking U.S. cash, right, moving out of U.S. equities, taking cash and then moving it back into yen in order to not then pay interest fees, which they were not prepared to pay on those no interest loans that had been taken for the better part of a decade. So currently the interest rate in the Bank of Japan is at, I think, 0.25%. It's very low. It could move up to 0.5%. That's potentially expected coming up on Friday. But in August, that meant, or it seems to suggest, that meant a serious retracement to the downside for the stock coming off of this very exciting price action, not only in May, June, but a run up to $30. I think we topped out at about $29.91 just prior to July OPEX. So there was a big sell-off heading into July OPEX on the 19th of July that peaked to the downside on that Monday, that Nikkei crash, or Nikkei-mageddon sometimes, as it's referred to, on August 5th. That's been the lowest price we've seen, right? The pre-market value of GameStop during that event was the lowest price that we saw on GameStop since the period prior to the events of Keith Gill's return to X and to Reddit in May and June of last year. So this was a pretty big retracement. But really, since that moment, GameStop's really kind of never looked back. We did return very briefly following. Was it just following? I want to say it was following our Q2 earnings report in September, down to about 1950, and then in mid-October down to about 2050, but really basically every month the floor on GameStop increased by about $1. So we saw pre-market value of $17.50, but an intraday value of $18.50 heading back to August. So is it possible that we're looking at something like that heading into the events of of today's, well, not necessarily today's trading, but maybe into next week's trading, something like that. It's possible. I don't know, right? It doesn't seem to be suggested that we would necessarily go that deep from some of the indicators that I'm looking at. And we're going to break these down a bit today. I'd also recommend, if you'd like to spend some more time thinking about this, if you'd like some more of our sort of overall context over the last year or so, with a special focus on the last year, maybe to think a bit about how we ended up where we are at this point in time. I have a video and an article from last week that I posted that gives a kind of overview and a recap of this, and sort of heading into January OPEX last week. So I'd recommend that those are linked in the article. You can go ahead and take a look at those if you'd like. Very helpful. I'd also recommend, right, Richard Newton this weekend put out some pretty good videos, I think, that give some good perspective on what we might be facing. I really appreciate Richard's videos. They're very well organized. He always does a very excellent job going through a number of different data sources that I don't necessarily touch on, but I find his videos in particular very useful, especially if you regularly watch my videos. Then watching Richard's as well, I think really complement many of the things I have to talk about. As I've mentioned before, we will often reach, this is always exciting when it happens, right? We will sometimes reach similar conclusions on things by approaching it from different perspectives and by looking at different sources of data. So I really appreciate Richard's video. Do go ahead and check out his videos from this weekend. And if you haven't had the chance yet, I'd also recommend you check out the very extensive expansion to the due diligence on GameStop swaps that Twitter user It Always Rains, but a Reddit user Always Sad But Truthful is the name there. So he's really done a really excellent job going through a lot of this extensive data on swaps that I'm really just kind of starting to penetrate and get into. But some really interesting finding there. So I'd like to go ahead and point that out to you. So go ahead and check that out. This is, of course, is also linked in the article for today. So in terms of our current market context, we ended the week pretty good. I do consult some of the resources that SpotGamma has to offer when thinking about our broader market context, rather than kind of doing brute force method analysis myself. But things look really good in terms of the broader market, right? We returned up, we moved back into call gamma dominant territory, stable trading, moved up beyond these more volatile positions, right? Of course, in SPX and SPY, downward movements correspond to increases in volatility. So we've moved out of this volatility territory. And on Friday in particular, right, we moved up above the SPX call wall at 6,000, stayed above it, tested it several times throughout the day. It held and then just closed slightly below it heading into the end of the day. So SpotGamma is expecting that we trade basically above the volatility trigger, which is where the dominant hedging regime starts to get a little bit more volatile, starts to build on itself as we move to the downside. So as we cross over SPX 5930, SpotGamma is calling that the volatility trigger for this week, that things might accelerate to the downside. So that's a level to watch out for in terms of thinking about broader market stability. And then, but largely they're projecting, at least earlier in the week, that we are looking at continued stable trading, basically between that 5930 level and the 6,000 level, that call wall area as an overhead. So definitely good to keep that in mind, to keep an eye on that. If we do indeed stay in those more bullish, stable sort of call gamma exposure dominated territory, right, lower volatility conditions, then that generally bodes well for GameStop. When the market tends to be in more stable conditions or bullish conditions, you do not tend to see kind of cataclysmic price collapse in GameStop. So, not necessarily that is a causal factor, but it does seem that institutions with the ability to short GameStop pretty heavily refrain from doing so, or for some reason are not as motivated to do so when we are in more stable or bullish market conditions. So that's certainly promising heading into this week. Obviously, that can tell us a little bit. Good to keep an eye on. As far as last Friday's price action, right? Very, very exciting there. We went into depth on this together live on last Friday's live stream. So go ahead and take a look at that. About the first 40 minutes of last Friday's live stream, we took some time to break down exactly what was going on here in terms of our price movement. Yeah, really. So some of the factors that I talked about specifically in my write-up on Friday and my write-up on Thursday were really essential. They came into play as key points within our trading day on Friday. So we did decide, right? So traders came out, walked us up a bit. We got walked up a bit. We got this little IV spike, and then we largely sold off down to about $27. So this looks like it was born largely, and it sort of nudged right through a significant amount of shorting. Nothing terribly concentrated, except maybe right here. We did have some. Oh, let me enlarge the screen here. Right, so right here at about 10:15, we had some more concentrated shorting that then was pretty much immediately covered. If we look at our borrow data, we can see that, right, first off, in the pre-market, the number of available shares shot up to about 1.8 million for a few hours and then came back down to about 1.3, 1.2 million, suggesting that that number of shares, as soon as it became available, was then taken off the board and borrowed by somebody, some sort of institution with access to these shares, likely in order to go ahead and nudge that move. So at least about half that short position was exited. I would suggest during this kind of retrace here, and we could see that around 11:30, 11:45, certainly by 11:45, about half of those shares, so at least 300,000 shares were returned to the borrowing pool. So that's basically right after this move culminated. So it looked like at least half the position was closed there and then returned. And then at this point, right, some continued selling. This can also just be the effect of charm, so delta decay over time, as all of these, like up here, all of these out of the money contracts, all those contracts at 30 especially, started to bleed points of delta throughout the day as theta value was taken out of the contract, thereby allowing market makers, allowing dealers who hedge the short calls, their short calls of those positions, right? The long calls that traders have at those positions, they hedge those short calls by purchasing shares. As delta goes down, they can then slightly and slowly unhedge themselves, right? They can sell those shares, release them back into the market, because the probability that those contracts will expire out of the money is increasing as time gets closer to expiry, which is imminent here. So we moved down to about 27. 27 was, of course, this level that I called out earlier in the day, right? So here's our covering pattern. 27, of course, was this level that I called out on Thursday. I noticed in particular that this was a bit of a strange level. So normally when you have put gamma and call gamma displayed, call gamma is almost always displayed as positive. Well, no, that is how the data is presented. Call gamma is displayed always as positive, and put gamma is always displayed as negative. Now, that is an idealized situation insofar as it is assumed on most stocks and with most trading, and this is largely correct most of the time, that traders are usually long calls and usually long puts, and that those the ratios at which they are tend to balance out such that you can treat de facto, you can effectively treat call gamma as trader long gamma and dealer short gamma. And so the properties at which dealers are going to hedge those positions are consistent across all call dominant strikes. And the same thing is assumed to be true for puts. So it's displayed always as trader negative gamma. So it's assumed that all gamma exposure on the dealer's books is positive. And so there's going to be consistency with respect to put dominant positions across the options landscape. Okay, now that's not actually right. That's true most of the time as a generality. That can function very well during trading, but that's not actually how it works, right? Because a dealer, right, especially at strikes that are not very heavily traded, one trader can come in and then change the typical composition of the dealer gamma exposure based on a trade that goes against that convention. And what we saw at $27 last week, especially on Thursday, that a trader had come in during the trading day on Wednesday and had purchased, had sold enough puts, right? Had sold a fair number of short puts at $27, enough that we could identify that this was a particular trader that did this, and that this had increased the total open interest at that put position at that strike at $27 by about 50%. So this very significantly changed the nature of dealer gamma exposure at $27. And accordingly, it projected that $27 was going to be negative on the dealer's books as a whole, meaning that dealers were going to have to hedge that position by buying shares. So GameStop's market maker was going to have to buy shares in the event that that price level was approached. So this actually runs counter to what typical dealer gamma exposure data tables are going to show you when they see that type of put position. It goes against the assumption. Now, because called that out, right, was able to identify that, heading into trading, we knew that $27 is actually going to be supportive. And sure enough, enough traders probably also knew that as well, that they were able to trade this by picking up, they picked up probably long calls here and just had this little day trade up to the 100-minute moving average. We went back to 27, maybe you had a little bit of another trade here. We can see from this white candle, probably something like that. But of course, then what's suggested is that this was a setup for something much, much deeper, right? And of course, all week we had been talking about the potential of a gamma ramp forming up, and a gamma ramp trigger is what we got. So as the stock, right, found stability at 27, traders started to buy it back up to this level here that had been day traded, but instead of stopping, it just exploded upward to $28.79 to the tune of over 2 million shares traded in about a half hour. Now, this intriguingly occurred at 1:45 p.m. Eastern time, the exact same time that the exact same type of move occurred within the exact same price action archetype that we had seen following Thanksgiving. So from 11:29 to 12:05, we had seen the exact same type of archetype appear in GameStop's price action. That is a heavy amount of shorting in 11:29 and 12:02. It took place over 2 days rather than just 1 day with respect to last week's trading. Then some sort of flat trading, IV bled, and then into the end of the week, we look to be being ejected, right? We had this sort of precarious kind of fall off of our price level, a movement down to about $26. It looked like we were really going to exit our trading paradigm. We were going to head maybe back to 25, maybe even sub 25. And then all of a sudden at 1:45 p.m., a post at the time you covered post by Roaring Kitty showed up at 1:45 p.m. And of course, GameStop moved up $5 exactly at that moment. Now, of course, many people speculated that this was yet another Roaring Kitty post that particularly pumped the stock, something like that, that was able to trap shorts. I talked about this as well, and it seems likely that it played something of a role in the magnitude at which GameStop was able to retrace back to the upside. However, so intriguingly to have absolutely nothing from Roaring Kitty this time, and yet at the exact same time at 1:45 p.m., we had the exact same type of move come in and explode our price upward. Of course, it ended up being of a smaller magnitude. We saw about an 8% appreciation rather than what would that have been? Something like a 50% appreciation, not a 50%, excuse me, 20%. So something like an 18% appreciation on 12.5. So it wasn't quite the same. So it's possible that Roaring Kitty's post did play some role in affecting the magnitude of our reversal to the upside, but very intriguing to see nothing from him. And yet we got this same type of move on the tail end of the same type of price action archetype there on Friday. So very, very interesting to see. Very interesting to see. And of course, what that did is that that moved us into a position right now, technically, where we're really kind of hovering on something of a fault line. It's really not clear from our technicals. It's not super clear from our options data whether a break to the downside or a slight recovery to the upside is clearly projected. We're getting a lot of mixed signals, and I'll go through some of that now. So one thing I noticed in particular that was very peculiar, and this is kind of adding another bit of insight, perhaps taking another look at really what what happened last Tuesday, and it really suggests that this was something very abnormal, right? This was not something that was indicative of organic price action. Just as I spoke during this period, if you go and take a look at some of the articles I wrote during the week of 12/2, just how much this caught well, it caught me by surprise certainly, but caught the market as a whole by surprise, is just how kind of unnatural this was. Now, back on 11/29, some of this to a certain extent made sense, but we did see some price action in there, right? Strategic order flow rerouting, tactical shorting through key options levels that did suggest that this was something manufactured specifically to disrupt our organic price action, to disrupt our patterns of authentic demand and how they play out on our charts. But this was especially egregious insofar as we look at this formation, right? I also wanted to highlight the degree to which volume has strangely characterized these movements, right? So many people have been talking a lot about wick-off accumulation and distribution phases, right? The phases of a wick-off cycle, things like this. One of the key factors of wick-off accumulation and distribution is the way that volume corresponds to certain price movements. So, for example, during an accumulation phase, if you see the price moving up and volume is moving up with it, then it is indicated that price discovery is occurring, that you are in the midst of an accumulation phase. And that when you retrace to the downside within that accumulation pattern, if you see volume go down with it, that is an indication that the accumulation phase is actually continuing. This is a minor correction. This is a retracement. This is a consolidatory move, but it's not an end to the overall trend. What we see here, right, you can see in these early stages, we see as throughout this entire accumulation pattern we saw at the end of 2024 and into early 2021, or 2025, excuse me, we can see that, right, as the volume goes up, GameStop's price goes up. And then when the price comes down, volume correspondingly comes down with it. Then volume goes up as GameStop comes up, and as it retraces, volume accordingly settles down. Back up, volume back up. Back down, volume back down. Even with this interventive shorting, right, volume down here. And then, whoa, super back up, right? Then through earnings, up, 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 and then up goes the volume. We have a slight correction, volume down. We then come back, price up, volume up. Price down, little correction, volume down. Price back up, volume up, right? This continues really throughout all of this here, this little correction here. Price down, volume down. Price back up, volume up. It is lower, right? Okay, so one thing to notice, we did kind of even off on this last kind of move up toward 34. We did show some weakness in our overall buying. This is true. We did not head back up to a test of 35. The second test we got, this kind of double top, as it looks, volume did trend up versus the previous kind of downward correction, but it was not as high as what we had seen on some of our previous up moves. Now, what is strange, however, is that the move down off of this high was actually even lower than the volume we had seen in some of these other corrections. And you can take a look here on our 4-hour chart, right? It gets very, very small as we headed back down to the downside. So that continues to suggest, well, okay, it's going to go ahead and test this. It'll test these technical bounds here, but accumulation does not appear to be done. And then all of a sudden, we get this teleportation downward. And then we have the resumption of something like a natural pattern, but again, volume still low. Now it's been extended, so the total volume in this periodization is higher than this shorter one here. But certainly, the way last week ended, we only got a volume spike again when the price went up. So it's not really clear. I mean, because of this move, it's very difficult to tell from our technicals exactly what we should expect. We are in a bearish paradigm, can't ignore that, but we don't quite have the volume yet to suggest that the price is going to collapse. And usually what you'll see is when price collapse is imminent, you'll see a big move down and a big volume spike in what is called capitulation. And that kind of brings the distribution phase to an end. So we are still in this bear trend. Could we see something like that? It's certainly possible, right? We haven't seen something like that yet, but really just so strange to see that that type of move kind of emerge there. It definitely sticks out. So I have some examples here too in the chart. If you take a look at how we looked heading into the Nikkei crash, right? Last July and August, this was authentic sell-off. This was authentic distribution, right? So we moved up, we have high volume, but then moving down off of this high, we have roughly equal volume. That's not what it looked like, right? Coming off of these last highs, right? Volume up. Look, you can see in the back-to-back days, the volume is almost identical. It's slightly lower, right? But it's almost identical as we're coming off of this high. Same thing. Then we get another day that is almost identical to 2-3 days prior. So this move is about even. And then volume is up, right? So then as we approach, we start to move down and it's a little bit, right? We move down, volume still elevated versus what came before. We move back up a little bit, volume comes up a little bit. We move down a little bit, but right across 2 days versus this, it's still a little bit up. It's kind of flat, right? Not really moving that much. But then when we get this kind of capitulation move and we really kind of slide down into the bottom here during this Nikkei event, we can see volume trends up, right? So price moving down, but volume trending up and doesn't peak until the bottom. So that's your capitulation move, right? That's the capstone of distribution. But you can also see the way that it begins, and the way that this move began was with equivalent volume on the way down. And it's a little tough to tell with our current trend. Right? Basically what we saw up to this price was, up to this point, is price up, price down, volume down, as I outlined before, right? Price up, price down, volume down. Then we have this teleportation candle, right? We have this day of teleportation where we just move down, we just kind of shift down, into a different register out of nowhere, and then move into this slightly bearish kind of consolidation pattern that hasn't quite found its bottom. Although finding that support at 27 on Friday did result in that big return to the upside. But even at this, right, we can see that within this trend, we have price down, volume down, and then price up, volume up. It's much smaller here, but that's still the trend we're looking at. So my point is here, this doesn't tell us much sort of looking forward, but it should help highlight the degree to which whatever happened on Tuesday, my argument was that it was a very high volume of interventive shorting meant to overcome certain options levels, especially that $30 call wall, to force the issue, right? To coerce the issue, to deconstruct that call wall by forcefully moving the price below it through interventive shorting, likely through liquidity that was created synthetically through ETF creation orders. As we've seen, right? We've seen shares available to borrow continue to tick up. Throughout this period, even though we're moving down, right? Shorts are happening, shorts are entering, but volume is going up. So something strange is going on here through this sort of synthetic liquidity creation here. So something like that is going on. If we look at some of our other technical indicators, again, we have some mixed signals. We did slightly close below the 200-week moving average. Not what you'd love to see, not optimal. A close of about 40 cents higher would have been a little bit more chef's kiss. We did stay right. We kind of reached the bottom right as soon as we hit this trend line, this kind of deeper trend line that I highlighted in Friday's video, talked about on Friday's live stream, as well as this indicator, this sort of RSI, the weekly RSI trend line that shows bottoms basically right when we hit our bottom in April, and then we reached the pinnacle of our bullish pennant coming off of the May and June price action in late October to now, right? So we're touching that trend line now in a way that would suggest, right, if it is going to function as a support, would suggest that we would reverse to the upside here. Although, don't necessarily love where we closed there. We did close a little bit earlier, slightly below, but this is, yeah, about not quite 40 cents below that line, which again, right, not necessarily awesome, but kind of mixed signals here. Nothing, not necessarily like, oh no, watch out, but still it's like very ticky tacky, right? Very ticky tacky. It could break either way. One kind of more bearish signal, I would say, is the degree to which yesterday's price action used our daily chart, used the 50-day moving average as a reference resistance level. So definitely don't love seeing the 50-day moving average above us being used as a resistance, because then that suggests, right, it seems like a proposition that, okay, you should read this as a significant level. So if this is a proposition for the market to take the 50-day moving average as an overhead resistance, then it's also a proposition that the market should take the 100-day moving average as a support point, which is down around 25. So, right, that's an indicator technically that's saying, all right, going forward, maybe going into January, that we're looking at something like continued sell-off, maybe down to 25, and then kind of playing around in this 25 up to kind of 28.50 kind of area. Not awful, right? I mean, that's certainly much higher than where we were. That's still progress, looking at some of these deeper levels, but that does suggest maybe a slightly more bearish outlook for some of the next few options expiry. So now as we look at our options data, we can kind of think about these questions are traders preparing for that type of technical move? Are they preparing maybe for a bearish reaction, some mild bearishness or deeper bearishness coming out of the Bank of Japan decision? Are they preparing for this technical move in GameStop to maybe move down what's been kind of forced by this teleportation shorting on last Tuesday and our price action kind of heading into the end of the week last week? Is this suggesting maybe that we do get that test of 25? And as I pointed out in the article in deeper detail, we do have some trades that suggest, not in the short term, right? So if we look at our trades this week, we don't really see a lot of new OI or old OI that suggests, I mean, some people are prepared in terms of puts kind of to the downside here, but we don't see any like kind of huge outstanding stuff, right? So this area in the short term is more shifted in terms of puts and in terms of long puts, but again, we don't have a ton of OI there. As we look a little farther out, right, okay, we do have some bearishness in terms of sold calls, kind of above us. Next week, also nothing like, 30 puts, almost 1,000 new puts at 30. Okay. Yeah, that, an in the money put for 2 weeks out, that could be considered a bet, a kind of protective bet, but we're not seeing that kind of sort of broader, feeling pain, feeling maybe risk, feeling need to be protected to the downside, at least in the next 2 weeks. Now that tune does change a little bit as we head out to February OPEX. So we do have, right, some preparation for bigger downside moves out into February OPEX at 25. We've got almost 7,000 puts out at 25. And we've got, I said 27 in the article. I made a mistake. I'll have to amend that. I said 27. We had 4,000. At 28, we then have about 4,500 puts there. So definitely right now, in terms of the February outlook, we are looking at some preparation to the downside, maybe to protect or capture some value down into that range. We don't have a lot penetrating much below there. In fact, we do have these, interestingly, right, we have these calls at 20 and 21. We don't really have much below 25. So this suggests, okay, maybe this is being traded for this proximal move here down to 25 for now. And why that far out? Probably also to insulate against, to protect against IV factors. So there are a couple ways you can kind of insulate yourself with a put against IV. One of them is to go deeper in the money, but of course that requires more cash. That's going to be a cash heavier hedge if you're going a long put that's deeper in the money. That's a way to do that. If you The other way to do it to protect against IV, right? Because with GameStop, as the price goes down, IV goes down. So if you're long a put, you're also fighting IV, right? IV is not helping you there. It's actually going against you, even as your put is moving into the money. So another way to protect against that is if you go far enough out, then short-term IV fluctuations are not going to affect that farther out position as much, even if it's out of the money and most of its value is built in extrinsically. So that kind of strikes me, that 25, that the preparation there, and we did see some of that. We saw that OI expand basically all throughout the week last week, in response to that bearish price action. So this does suggest, yes, there are some traders who are preparing for a deeper, the potential for a deeper move now. Some of them probably have already captured some value on what happened. Although I will say that our price action on Tuesday was like, it unfolded so quickly. I'm not sure to what degree those traders who opened those puts in February have already been able to capture some of that value. So probably a bit, right? Because we still ended at 27.50, and we did have a point where we moved back into the 29s, I think, on Wednesday. So, maybe, but yeah, this is yeah. Did I get this? Oh, I think I maybe double posted this. That's okay. Max pain for this week, $28. Highest call OI, 30. Highest put OI, 27, right? So certainly from where things stand now with our max pain data, looking pretty good. We have a surprisingly small number of calls that are in the money right now in terms of this expiry. So this is in excess of 95% of our call OI is out of the money for this week. You typically don't see that. And a really high amount of our put OI is in the money. So, certainly that ratio in the short term suggests, okay, yeah, we're maybe we retrace a bit to the upside. I could see something like, right, dealers, because they already have this kind of max pain. Okay, it's idealized a bit, but it's probably somewhere around here, especially because we see as the weeks go out, right? Next week is 27 for right now, and that's pretty well developed. Feb 7 is 28. That's not crazy well developed, but it's got some OI, right? Feb 14, we still don't have too much there. 21, 26, right? So for these next few weeks, especially these next 3 weeks, we're 28, 27, 28. We're up there. Our max pain is elevated. It's not like, well, it's just this week, and then next week it goes down, and the following week it's down in the gutter. No. So this kind of suggests that we stay, how strong of a suggestion? Mild, right? It's not crazy. Again, it's another kind of mixed signal, but at least from the options data, we can have some suggestion that at least dealers, right? Dealers are not necessarily incentivized to take extraordinary measures to push our price down. Now, does that mean other institutions might not be incentivized to do that? Right? I don't know. Right? I don't know how much of this. Richard's been talking about this. Always sad but truthful's been talking about, well, this to a deeper extent, but especially Richard. Right? Richard's been tracking kind of, oh, hey, how does our price action correspond to some of these swap roll dates? Right? Maybe there's some incentives in terms of that. I don't know. Right? I haven't been tracking that. That's not where I've kind of specialized. But if we're looking at our options data, at least I can say that dealers are not incentivized to push us down versus where our price is currently, kind of around the 27, 28 range. They're not super incentivized to do that. And I would say based on our call ratio here, right now, I would say they're probably incentivized to let the price run up a little bit, right? IV levels are down low, as we'll see in a sec. IV levels are pretty low. It does suggest maybe we have a mild retrace to midweek. IV can recover a bit. Price can recover a bit. This will, sort of send things aren't so bad. Okay, take some of the fear off. Maybe a little bit more money flows back into long calls. Dealers put those in their pocket, and then, just let the price, let charm, right? Maybe a little bit of nudging, but not too much, kind of carry the price down into, back to 28 or 27 or something for a max pain finish for the week. And then they kind of happy enough to pocket all the extra premium that comes in as a result of that. If they kind of just let this run down now, I'm not sure that doesn't encourage a lot of options buying, right? If let's say it runs down $1 a day and it goes to 2026 or it goes down to 25.50, like, the move's already happened at that point. What else are you going to hedge? Is it going to be peak fear? Does it, well, GameStop fear doesn't necessarily cause a run on the options market on GameStop because of the weird sort of way that Ivy works with puts. So in a longer downtrend, so like in the 2022 to kind of early 2024 area, we did see a greater proportion of puts. So we did see people trading that. And IV was lower, right? It was kind of only spiking around earnings time. So it was a bit less risky to trade puts in that environment. That's still not the case. That's still not the case now. So, that's not a guarantee. That's kind of me just speculating on what I would think would be most advantageous for dealer profitability, for options dealer profitability. Again, not really factoring things like swap rolls or foreknowledge of what might happen with the Bank of Japan. But that's a promising sign as far as our options data is concerned, right? Our put to call GEX ratio kind of staying stable, right? It's not nearly as bullish as it was, but we're still not into that very high ratio around 1 that we were. I think we were at 0.92 basically when we had the Nikkei crash. So could be worse, could be a lot worse. And then if we look at our gamma exposure data here, again, right, we're just not, well, number one, we have half the amount of gamma exposure on the board. So, every dollar spent in the options market is going to go about, it's going to, go either twice as far or half as far, right? Depending on how it's being resisted. So it's only going to be resisted half as much, but also supported half as much. So we have right where our price is right now at 27.50. We have a slightly put dominant, but there's so little actual put OI down there, mostly kind of neutral territory beneath us. So not a lot of hedging kind of going on at all. And then above us, immediately above us, again, we don't really get into thicker, say, call gamma dominated territory. It's more stable above us. We do get some supportive hedging in there, kind of stabilizing the price. But really not until the call wall does that kind of emerge. And then, we still have some old contracts up in the lower 30s that dealers will probably be happy to have not close in the money or kind of get threatened. But so, we do see shares going up back into the 2 million shares available to borrow. If somebody wants to come out and short this, they definitely can. And it's going to go down and it's not going to be resisted really until we get something of a speed bump at like 25. Now, like I said, I don't think the market maker is necessarily going to be incentivized to do that because Max Payne ideally is up in this area. What do they gain by really pushing? There's only 3,000 calls above us right now there's only 3,000 calls below us that are out of the money or that are in the money. And there's only about 2,000 or 1,500 puts that are out of the money. So it's like by pushing it down, there's not really that much more for them to gain at this point. I would think that it would be more profitable for them to kind of let up a little bit, right? Let a little bit of calm, let a kind of deep breath happen in the market as a whole, let IV kind of recover a bit, let the price kind of grind up into this area a little bit. It doesn't have to be big volume, but let it kind of move up, and then kind of reverse off the call wall and then close essentially back down where we are kind of now, or maybe slightly above that at like 28 or 28.50 or something. I think that just kind of having that volume, right? Because dealers, because they're striving to remain neutral, like it's on volume. Their profitability in the options market is heavily based on volume. That's why they hedge. They want to win no matter what, and they want it to just be dependent on volume. Just like day traders have strict rules for entry and exit. They have, they abide by strict conditions. They don't really make discretionary decisions. Like the best day traders have rules. They have a set. They know their win probability, and they know the situations where they have that win probability, and they stick to those so that they're just on the hunt for that setup or those setups. And they know their stop loss targets. They know their profit targets, so that it's really just a question of volume. It's just a question of volume. It's not a question of, oh, am I going to win this one? Oh, am I going to lose this one? It's just, oh, if it does this, I do this. If it does this, I do B, whatever it is. And, I know that if I just keep finding, right, it's not a question of entering and exiting, right? It's a question of just finding the right setups. And then they have their profitability is guaranteed as long as they're properly accounting for things like slippage and whatnot. Something like that here, right? With options market makers, it's a question of volume. Just get people to buy the contracts. And the more that people buy the contracts, the more they profit. Yeah. So those are my thoughts there. Does that have to happen? Right? Of course not, right? It doesn't matter what I think. I always feel it's important, right, to make that reminder. It doesn't matter what I think. All right, I can think whatever I want about what's going to happen. What's going to happen is what will happen. Pointing out some of these insights, pointing out some of these data points, being able to offer these scenarios can sort of certainly helps me kind of say, okay, what do I want to be focusing on? What do I want to look out for? How might this, if I can anticipate this, how might this kind of better guide my trades or how I balance my positions or something like that, heading into the end of the week. So yeah, like we see shares kind of going back up. And we are reaching some interesting IV lows here. So to me, this does suggest dealers will let kind of IV recover a little bit in order to profit. Doesn't mean that after this week, they're not going to go down, right? They could then continue to push it down. Like I said, doesn't look like that so far in the options market, but things can change. They can develop dynamically depending on that decision from the Bank of Japan. But, for now, that's kind of what looks to be the case. So, as always, thank you guys very much for watching and listening. Wonderful to have a chance to talk to you as well. Best of luck out there. Thank you, of course, to Christian Matseda for supporting today's video and today's post. And of course, as always, to support from Dat Scruffdo. Thank you, Scruffy, as always, for your support. And to all of you who have generously sent coffees in the past or have sponsored upcoming newsletters and video breakdowns. So thank you very much, everyone. Good luck out there, and we'll see you tomorrow. Take care.